Welcome to the Explainer. Right now, we're looking at a global market that seems, well, completely confused. One minute it's hitting record highs, the next it's flashing recession warnings. So how do you make sense of that? Let's get into it.
Okay, so let's just dive right into the heart of the problem. You've got the S&P 500. It's flirting with an all-time high. That's pure confidence, right? But then you turn around and JP Morgan is saying there's a 35% chance of a recession. It feels like whiplash. How can both of these things be happening at once?
So here's how we're going to break this all down. We'll start with these contradictions, then get into what the Fed is doing with this so-called hawkish cut. After that, we'll look at the economy's tug of war, a couple of big wildcards, and finally, what this all means for 2026.
All right, first up, the market's split personality. And look, this isn't just about some people being optimistic and others pessimistic. It's deeper than that. The market itself feels like it's been cleaved right in two.
So you got to ask, where does a split like that even come from? Well, a lot of it points to one place, and it's this week's biggest story for sure, the U.S. Federal Reserve.
Okay, so this brings us to the Fed. And this is where things get really interesting, because their next move is creating a ton of this uncertainty. It's not really a question of if they'll do something. It's all about how they do it.
Look at this number. The market is pricing in an 87% chance of a rate cut. That's practically a done deal in Wall Street terms. But here's the thing. The cut itself isn't the real story. Nope. The story that has everyone holding their breath is in the fine print.
And that's where this great phrase comes in from Jeremy Siegel over at Wharton, the hawkish cut. It's such a perfect description of the tightrope the Fed is on. Think about it. They're going to give us a small rate cut, but the speech that comes with it, it's going to be tough, cautious, basically telling us, hey, don't get too excited, we're still fighting inflation. And this just shows you how much tension there is inside the Fed itself. Siegel's pointing out that we might see a record number of people actually voting against the decision. You've got some folks who want to cut rates more aggressively and others who want to just hold the line. That kind of internal disagreement, that's what makes this whole thing so unpredictable.
So why does any of this matter? Because even a tiny, grudging rate cut has a huge real-world ripple effect. We're talking over $15 trillion in loans. That's your credit card bills, your car loans, how businesses pay for stuff. So even a small cut means real relief for millions of people, and that injects some juice into the economy, no matter how cautious the Fed sounds.
And you can see why the Fed's in such a tough spot. Just look at the economic data they're looking at. It's a complete tug of war.
So on the one hand, you've got the job market, which is still surprisingly strong. Almost 7.7 million job openings. That's way more than anyone expected. But then, on the other hand, you'll look at the crystal ball, the indicators that try to predict the future. And they are flashing all sorts of warning lights. They're pointing to some serious fragility down the road. And this timeline of the leading economic index really lays it all out. Just look at the trend here. The decline isn't just happening, it's actually getting worse. It's accelerating. And that steady drip, drip, drip downward, that's what has economists so worried. It's a huge signpost pointing to a slowdown. The conference board themselves are calling it fragile and uneven. That says it all, doesn't it?
Okay, but the Fed isn't the only game in town, right? They don't operate in a bubble. So let's zoom out and look at a couple of other major wildcards that are stirring the pot right now. A huge battle in the media world and, well, oil prices that are just falling off a cliff.
So first, you've got this absolute soap opera playing out in the streaming wars. Netflix puts an $83 billion deal on the table for Warner Bros. Discovery, then boom, Paramount swoops in with a hostile bid. And just to throw another wrench in the works, President Trump is talking about a possible antitrust review. That kind of drama in such a huge sector, it sends shockwaves through the whole market.
All right, now let's switch gears completely. Over in the energy markets, oil prices are telling a very, very different story. We've seen U.S. crude prices fall more than 15% in just a year, from $70 a barrel down to $58. That's not a little dip, folks. That's a serious slide.
So what's going on? Well, in a word, glut. A super glut, actually. All these countries that aren't part of OPEC+, they're pumping oil at record levels. And when you have that much supply, it's a huge reality check. It basically tells you that the global demand from factories and consumers just isn't there to soak it all up. And that is a classic, textbook sign of a weakening global economy.
Okay, so let's try and tie all these threads together. We've got the Fed, the mixed data, the media drama, the oil glut. What on earth does it all mean for 2026? Well, JP Morgan's latest outlook actually gives us a really interesting way to think about it.
And this quote right here, it just hits the nail on the head. The key phrase is multidimensional polarization. Think about that. It's not just one single divide. It's a bunch of them, all happening at once. You've got the stock market split between the AI darlings and, well, everybody else. And you've got the economy split between huge spending on tech and a job market that's starting to look a little soft.
And when you look at their actual numbers, it paints that exact picture. An economy that's tough, but also kind of fragile. That 35% recession risk, it's still there. They think borrowing costs are going to stay high. It's this world of, let's call it cautious optimism, where you have these pockets of amazing growth right next to some pretty serious risks.
Okay, so let's do a quick recap. What are the big takeaways here? 1. The market is torn between now and the future. 2. The Fed is about to give us that hawkish cut. 3. The economic data is pulling in two directions at once. 4. The crash in oil prices? That's a big warning sign for global demand. And 5. The word for 2026 is polarization.
And all of this leaves us with one last, really big question to chew on. In this new, polarized world, what's the deal with AI? I mean, it's the biggest force out there. Is it going to be the engine that just powers everything forward, lifting up the whole global economy? Or is it just going to make all these divisions even worse, creating an even bigger gap between the haves and the have-nots? Honestly, the answer to that question is probably what's going to define the entire year ahead.